paying taxes suck. But for most of us, we know why they're necessary and what the purpose of them are, but you don't want to be paying anything more than you're legally obligated to do so. However, many people going to retirement without proper tax planning actually overpay the IRS by thousands of dollars each year. In fact, most retirees don't realize that going into retirement over the next 20 years, they're going to be paying north of 6 figures in taxes alone. In fact, the last tax projection I just did for somebody at age 63, by the time they're age 80, they were going to pay $470,000 in taxes alone without proper planning. So today I'm going to be sharing 3 ways that you could be reducing your tax bill in retirement. First thing you can be doing to reduce your tax in retirement is just getting a better understanding of how taxes work. Specifically, how do the tax brackets work? The reason this is important is when you understand how our brackets work, you can, in a way, manipulate where your income comes from and gauge where your taxes are going to be. In the United States, we have a marginal tax system, which means the first $20,000 we earn as a married couple is only taxed at 10%. After that, every dollar is taxed at the 12% level until you hit that top of that bracket, and then you go into the 22 and so on and so forth. Many people are in the assumption that if I'm in the 24% tax bracket, I'm paying 24% on all of my money, and that's just not the case. If you look at what your average tax bill is, most people are in somewhere in the teens still. So don't let the marginal or the top end of your bracket scare you thinking that you're paying more taxes than you actually are. Now, once you get a better understanding of how the tax brackets work and how each of your different retirement accounts is subject to those taxes, you can create a plan to start reducing your tax bill. So for example, if I know I'm making $60,000 in retirement and that once I go over $89,000, I cross into the 22% bracket and I want to avoid that, if I need to take a chunk of money out, let's say I need $30,000, I could pull $20,000 out from a pre-tax account, which gets me right up to that limit, and then I can take the remaining $10,000 out from a bank account or a Roth IRA or something like that that I already pay taxes on. That way I still get my $30,000, but I only pay taxes on 20. I cut myself out of that 22% level. Another example of how understanding your tax brackets and the way it works can benefit you is, let's say you have an income of $100,000. Let's say you had $50,000 of earned income from working, or maybe even a pension, Social Security, just $50,000 that's subject to taxes. And let's say you took $50,000 out of an investment account. Now the first $50,000 you pull are going to fill the initial buckets. And when you're pulling money off of an investment account and you've had the money in there for over a year, you actually get special long-term capital gains rates. And they actually do have a 0% bracket that applies up until you make $94,000 as a married couple. So let's say you have a married couple and taxable income in the household, $50,000 in retirement. So maybe it could be from pension, Social Security, wherever the income source is. Let's just say it's $50,000 a year. Now, if you take the standard deduction, which in 2024 is around $30,000, it actually is going to drop their income, their taxable income, from $50,000 down to just $20,000. Now, $20,000 is actually under the income threshold of that 10% bracket. So they only owe 10% of that $20,000 or $2,000. And then if they turn around and pull $50,000 out of an investment portfolio, so not a pre-tax account or not a Roth, but just an investment portfolio, they pulled it out, and if they had that money in there for over a year, they get special long-term capital gains rates. And what a lot of people don't realize is that the 0% capital gains rate goes until your income is $94,000 as a married couple. So if this married couple's income is only $20,000 and they pull 50 out, now they're up to $70,000, they're still under that $94,000 threshold, which means they paid no taxes on any of that money that came out of the portfolio. So they essentially made $100,000 of income. They had to pay tax on $20,000 of it. They paid a 10% rate of that $20,000, and they ended up paying just $2,000. So they paid basically 2% on an average tax bill of $100,000 of income. This is why it's important to understand how brackets work and how different retirement accounts can have different tax implications on you in retirement. The next way to reduce your taxes in retirement is just getting strategic with Roth conversions. So Roth conversions, it's just a tax planning strategy where you strategically move money from a pre-tax account or an account that you never pay taxes on yet and move it into a Roth IRA account. And when you do that, you do pay taxes on what you move over at the current rate. But once it's in that account, it's going to grow for you tax-free. If you pass away, your spouse inherits it, it's still tax-free to them. If your kids were inherited, it's still tax-free to them. So once it's in the Roth account, it's never taxed again. There is a 5-year rule that applies to these things. So every time you put money in there, it has to stay in there for 5 years before you're able to withdraw without taking a penalty. And when you look at where tax rates are headed if the national debt's high, and just what the tax code says is in 2026, the rates are set to expire and the brackets are going to go up for everybody. So basically, if we do nothing, taxes automatically get higher. So if we can take action now and pay taxes at our current rate, instead of paying taxes at a higher rate down the road, we're going to save a little bit initially just from doing that. Now remember that as money grows, so does the tax bill in them. So if account goes from $100,000 to $500,000, now you have to owe taxes on that $400,000 of gain. If it was in a Roth account and the 100 would go to 500, it would be tax free. So Roth conversions, they're more of a long-term strategy play. But if you're trying to reduce income for yourself, especially if you're doing it for a spouse or a beneficiary down the road, these are one of the most powerful tax strategies out there. And when you think about it, taxes can only do one of three things. They can either go up, stay the same, or go down. So if you say had $500,000 in a Plan 3 account and you said, hey, I really don't need this money because I have enough from Social Security, rental income, whatever. I don't need the money. I'm just going to let it sit and grow. The tax bill on that right now, let's say if you owe 25%, would be about $125,000. That's kind of the unpaid tax liability you have on that money. If we don't do anything about it, and let's say it doubles in the next 10 years, now you have $1 million in the account, and assuming taxes didn't change, what just happens, your tax bill just doubled. You're now have $1 million, you still owe 25% of it, now you owe $250,000 to the IRS. Under that same scenario, let's say that money doubled, but let's say taxes drop from 25 to 15%. If you owe 15% of $1 million, it's still $150,000. It was more than the $125,000 you owed 10 years prior. Plus, you missed 10 years of tax-free growth opportunity by not taking advantage of it. So you can see Roth conversions, while you still end up paying taxes on them, when you look at them over an extended time period, you can see how they can easily save you 6 figures in taxes alone. And they have a couple other hidden benefits for them as well. Remember, once the money's in there as a Roth, they can come out at any time tax-free, which means it's not going to impact your Social Security or your taxes in any way, shape, or form. So if you're pitting on the edge of jumping from, say, a 25 to 30% bracket, and you had money in a Roth, you could pull that money out and it wouldn't impact your tax brackets at all. When we do Roth conversions, we also are lowering the amount that's going to be subject to required minimum distributions down the road. So the IRS isn't patient for long. Starting at age either 73 or 75, you're going to be required to take money out, whether you want to or not, off of this account. They're going to force you to take these distributions and pay taxes on it. So if you're sitting there $1 million at age 75 and they say, hey, now you got to take 3.3% or 33 grand out, $33,000 has to come out. It's all subject to taxes. Now, what bracket that puts you in is going to be kind of up in the air depending on where rates are. So you're not quite sure how it's going to impact you until it happens. But if I took $33,000 out and say I was in the 25% tax bracket, a quarter of that has to go to the IRS. If Congress changes the next year, let's say taxes are 50%, I'm required to pull that money out, and now half of it goes to the IRS. So you essentially lose control of your money. You're being forced to take money out you don't want or need, and forced to pay taxes at potentially an unfavorable rate to the IRS. So being really proactive younger in your retirement can make a really big impact and help you reduce or avoid altogether the required minimum distributions. Now, the third strategy to reduce taxes in retirement is just using strategic charitable giving. So if you are charitably minded and you give each year to organizations you care about, we know that it should be a tax deduction, but many people don't realize that you only get that benefit for the amount that goes over the standard deduction. And right now, for married couples, if the standard deduction is $30,000 and I give $5,000 or $10,000 to charity, chances are I don't have enough other deductions to itemize to make it worth more than $30,000, which means you get no benefit for that charitable donation. So one strategy you could do is you could lump your charitable contributions together so it adds up to be more than the standard deduction. So for example, if I was giving $15,000 per year to charity to care about, under the current rules, I wouldn't get any benefit from it because the standard deduction is higher. But if I did a lump sum, let's say I combined 3 years worth, and I did $45,000 to them, because the $45,000 was more than the $30,000, I would actually get the benefit of writing off that extra $15,000. And you can do this to things like a donor advised fund where you can lump all the money in together at once. So if you still want to do the $15,000 a year, you still could. You're just going to realize the benefit in year one, and then you can distribute it for the next few years. A second charitable giving strategy that becomes available once you turn age 70 and a half is something known as a QCD, or Qualified Charitable Distribution. Essentially, any money in an IRA that's obviously pre-tax could be used and sent directly to a 501c3 or nonprofit account. Now, when I pull it off of my pre-tax account, remember, this is money, I haven't paid taxes on it yet. I'm going to send it to a nonprofit. When they get the money, their nonprofit, they don't pay any taxes on it as well. So it allows me to give more money to that organization, because the reverse of it is, if I wanted to give $10,000 to a church If I pull $10,000 out and pay 20% tax, I'm left with $8,000. And then I give the check to the church, they only get $8,000 from me. If I say, hey, take it from my IRA, I want to do $10,000, then the full $10,000 would go to the church. So now the church gets a full $10,000 or $2,000 more than I would have given them anyways. Because I didn't take this money out, I didn't have to pay taxes on that $10,000. So I avoided paying money on these taxes and I gave more to the organization I care about. So it's kind of a win-win situation. Now, there's really no way it plays out that you can give to charities and actually come out ahead in terms of taxes. So you only want to give to charities that you care about. There's no weird strategy where you can give so much away to lower your income and actually come out ahead. Because at the end of the day, you're still giving up every dollar you give to that charity. So these are just a few strategies that you could potentially use to help lower your tax bill in retirement. If you're currently in retirement or you want to get ahead of this and want to start being proactive, then I encourage you to start getting a financial plan today and really dive deep into tax planning. Probably not something that you really want to read up on in your spare time. So if you need help with this, that's something we do for our clients all the time. The link to get on our calendar will be in the description below. If you're not ready to take that step yet, feel free to grab a copy of our 10 tax myths that most people believe. This will be a real short guide of common tax myths that you may have heard of before that simply aren't true. And it's just gets you one step closer to getting more financially educated, especially in the tax planning space. That link is in the description below. That also gets you signed up for our weekly newsletter. All right, with all that being said, I'll catch you guys next time. Remember that your future depends what you do today.